court, they've decided that they needed to restructure the member benefits that they offer, and they needed to add some benefits to provide a really compelling value to the members. And I really have to give credit to Amy Martinez, Liz Neely, and Sam Clinch for their leadership in identifying not just this product, but a variety of other products and services that they're working on as being things that they can do to offer real substantial value to the membership. And you know, they say that big organizations move slowly. I think from the idea stage, when this was just a random thing scribbled on a legal pad in a meeting, to the point where we had a definitive contract signed with a competitive bidding process and full rollout, I think it was less than 6 months. And it's really admirable that Sam and Liz and the rest of their team were able to work with us to get this thing done as quickly as possible and get it in everybody's hands. So this is a member benefit that's available to anybody who pays the full dues. Effective this week, we just entered into an arrangement with UNL Law and with Creighton Law, where any law student who wants to can get a login for this. And we've created logins for the professors too. So for the folks that are going to be hiring law clerks this summer, your law clerks will have access to it if they're enrolled at one of those two schools. And we expect that the professors are going to start teaching this as part of the family law curriculum in the school. So hopefully the next crop of lawyers will be even better prepared to just jump into this thing head first. So let's begin. This is a web-based product, and to sign on to the product, you can either go to www.nebraskachildsupportcalculator.com, or you can go to the Bar Association's website, nebar.com, and just click on the giant green box that is prominently displayed on the front page, and it'll take you over to my site. We're in a transition stage right now because this used to be a product that was sold for a private subscription, and there are some people that still have active subscriptions that they've paid for that they're entitled to use. And so that's why there's the red boxes and so forth on there, because there's actually two different login mechanisms. But if you're a bar member and you're using a free subscription, that's going to be the default page that comes up. Your username is your bar number, and your password is whatever password you've set to sign on to the Bar Association website. Now, if you're like me and you hate passwords and you can't remember them, the password help function, if you click on that on the left-hand side, will actually take you back to the Nebraska Bar website, and the password reset feature there will reset your password globally for the entire Bar Association, which would cover CaseMaker, nebar.com, and my product. What we do is actually kind of unique, and took a while to get it going, but it's kind of cool. We do a real-time check on the Nebraska Bar's server. So if you happen to have a snafu and your dues run out and you haven't paid them, and you call them and get reinstated over the telephone, almost instantly your account's going to come back active again, and you'll have access to this. So this is a real-time query, and it checks right now, have you paid your dues, and do you have a good account, and is this a good password? So I'm going to try and remember my password and see if we can sign in here. Once you sign in, you get to the main menu, and 9 times out of 10, documentation, who needs that? That's why you're here, right? And then Nebraska guidelines, people are going to be familiar enough with them. Most of the time, you're going to jump down to the third item on the menu right there, which is the main form that you use to run a child support calculation. And so what I'm going to do is I'm just going to plug in some bogus numbers here and just kind of start with a generic calculation, and then we'll go down and we'll explore some of the features here. This is really a webinar on how to use the product, but it's also there's some add-on stuff that we can cover in terms of unique situations that people encounter and how I try to handle them. So the first version of this product didn't have a case name, and apparently that was a big deal for people, so I finally added that. You can plug in your case name, and you'll see where my stereotypes are. This is my, this is kind of my prototype calculation that I use to demonstrate everything. I assume that the mom makes $3,000, I assume that the dad makes $5,000, and I assume mom has the kids. And like I've said before, if your practice is predicated on the notion of whatever they're calling it these days, equal time or father's rights or something like that, you can start by just reversing this mentally in your head, and then when we get into joint custody, I'll show you how that's done. So when we talk about income, the first thing that I did, there's another product out there that has actually been pretty well established in the market that is probably in force, or probably was on the market for 10 or 15 years before mine was. And when I started writing this, the first thing that I did was I made a list of things that I spent a lot of time doing before I started even plugging things into the software, and I tried to eliminate as many of those as possible. So in this instance, one thing that I spent a lot of time doing was I had clients that came to me that said, well, I don't know what I make monthly. I know I make $12 per hour. Or somebody who maybe works at Kellogg's or UPS, they know that they make $700 per week. Or I have a wife come in and say, I don't know what my husband makes per month, but I know he makes $100,000 per year. And so the first thing that you can do here is you can set your pay period based on however you want. This is particularly useful when you're dealing with people that maybe they're not even working up to their full income capacity, and you have a court that's going to impose an earning capacity on somebody. And so it's pretty common that you have somebody who's maybe a homemaker, and the court imposes an earning capacity on them of $10 per hour. Well, under the old system, you would have to do $10 per hour times 40 hours per week times 52 weeks per year divided by 12, and on this one you just plug in $10 per hour. So I'm going to do that, and I'm just going to leave everything else as is, and I'm just going to show you what a basic calculation worksheet looks like. This is what it looks like. On the mother's side here, it's translated that $10 per hour by applying the formula, and it's turned that into $17.33 per month, which if you do these enough, you just know that's what it is. And then on the father's side, it hasn't done anything because I entered that as a monthly figure. It's given us federal and state taxes, it's given us Social Security, it's given us Medicare, and by default, since the guidelines allow a 4% deduction for retirement, at least at the present time, the retirement is factored in at that level. If I want to take the retirement out, I joked at the last time I did one of these. We were showing about, I was doing the low income calculation, and I had the retirement box checked, and somebody joked about whether people that are below the poverty level contribute to retirement. Of course, my response was everybody does, because it's allowed as a deduction. But in this case, let's change the facts a little bit, and let's say that the mom is not contributing to retirement. I have 0 plugged in the retirement box, but I have to uncheck the box that says or 4%. If that box is checked, it's going to override whatever you put in the actual numbers box. So if I uncheck that box and then I hit recalculate, now sure enough here on the retirement line, mom is in at 0 and dad is in at $200 per month, which is 4% of the gross amount. So I want to go back to my calculation form here. I'm going to show you a few other things. First, a word about tax-free income. In this particular product, I have 2 categories. I have income that is subject to the full boat of taxation, which would include federal and state taxes, Social Security, and Medicare. And then I have the second category, which is completely tax-free. So some examples of tax-free income would be when you have a military family and there's a housing entitlement. That's on their leave and earnings statement as BAH, and then a sustenance entitlement, which is BAS. Those things are tax-free and they go in here. Everything else you should probably put in the full taxable income field. Now, on my Iowa product, since that product was written several years after the first version of this one, on my Iowa product, I actually have 3 fields. I have a full tax field for earned income. I have a taxable unearned income field, which is subject to income tax only, but not payroll taxes, Social Security, and Medicare, and then I have a tax-free field. And that trifecta is probably coming to the Nebraska product at some point, at some future point. It's not as easy as it sounds to just add the box. So it's coming at some point in the future, but for right now, if you have unearned taxable income, which would be pass-through income from rental real estate, pass-through income from S corporations, those types of things that are going to be on Schedule E of a tax return. What I do is I tell people to figure out what the FICA tax is going to be and then subtract out the FICA tax under my other deductions field. Is what I have people do until I get that feature added. It doesn't happen very often. I think in my career I've seen enough of this unearned taxable income that where it really moves the needle on a child support calculation, maybe 1 case per year or something like that. It doesn't happen a whole lot. But anyway, that having been said, so the tax-free income field is best used for stuff that truly is tax-free. Somebody who gets a tax-free auto allowance, somebody who gets a housing allowance through the military, something like that. A word about the filing statuses here. You should really choose, depending on the situation, single, married filing separately, or head of household. The married filing jointly filing status is in there for even less cases, probably 0.5% or 1% of all the cases. And the reason is this. I get my tax data from the Internal Revenue Service, who issues a revenue procedure every year in late December or early January, depending on how badly Congress is fighting over the upcoming tax rates. And that revenue procedure gives me all of the inflation-adjusted income tax brackets for the year because they're required to adjust them every single year. For the married filing jointly tax bracket, I include the full bracket, which assumes there's going to be 2 taxpayers that have incomes that's going to flow into that joint return. And so the married filing jointly tax brackets are twice as big as the married filing separately tax brackets. So even if you're dealing with a modification of child support after the fact, even if one of the parties has got remarried, the only reason you would do married filing jointly is if they got remarried and their spouse doesn't have any income at all. So a good example would be a doctor that gets remarried and the second spouse is a homemaker. Well, in that case, it is proper to use married filing jointly because by virtue of filing a joint tax return with the non-earning spouse, that doctor gets more favorable tax treatment. But it would be grossly unfair to do that in a situation where somebody's remarried and their spouse has income, particularly if the spouse's income is the same as or greater than theirs, because what's happening is the calculator here assumes they're the only taxpayer filling that bracket, and they will grossly underestimate the tax that that person has to pay. So if an opposing counsel gives you a tax return that has anybody in there, or I'm sorry, not a tax return, a child support calculation that has anybody in there as married filing jointly, giant red flag, the income is going to be way skewed, and you would be right to object to that. So head of household is interesting. People don't realize how often that applies. There's a little known exception. I think most people are familiar with the general rule that if you're still married and one spouse itemizes, the other spouse has to itemize. If you dig deep into the Treasury regs, and I don't even know why I have, but I have, there's an exception that states that if you're physically separated for more than half of the year, and the person who has the kids more is eligible to file as head of household, they are no longer coupled to the other spouse's filing election. So if the mom has the kids and they've been physically separated for half the year and the mom files head of household, she can take the standard deduction for head of household and whatever exemptions the parties agree are going to be used. And then the dad can file as married filing separately, which normally would be a kick in the shorts, but the dad can take the itemized deductions for the entire family, which is sometimes, not often, but sometimes that actually creates one of these weird situations where by filing separate tax returns during a divorce, you can actually get more money out of the government. So this is one of those things, and particularly if you're presenting this at trial where it's going to be permanent, chances are whoever has the kids more is going to be claiming head of household. So I usually do either head of household or single. Only when I have a high income case and the marriage penalty tax is going to be a big factor when I do married filing separately. Your self-employed option here, I'm going to just turn on. I'm going to set these both at $5,000, and I'm going to show you a calculation so you can see what effect that does. People who are self-employed, here you see, I need to actually set everything equal so you can see the difference. People who are self-employed pay double the FICA tax. That's the only difference that you're going to see here. So in this particular instance, you have mom and dad each making $5,000. They've got the same federal tax. They've got the same state tax. But look at this. The dad, who I've flagged as being self-employed, is paying twice the Social Security and twice the Medicare. Now, confession time. The other guy's product calculates self-employed taxes differently than mine does. And for years and years and years, I thought I was right, and I've had a change of heart. And in the next couple of weeks or so, I've already written the code for an update that will bring mine in line with what the other guy's product is supposed to do, except the other guy's product has a minor error, and so then mine will be right and his will be wrong. But it'll at least be closer. It'll be within a couple of bucks of net income, and the child support calculation itself will be the same because we round to the nearest dollar. But I've decided I'm going to capitulate on this one because I'm tired of having lawyers call me and say, why is this different when I have a self-employed person? The difference is that when you're self-employed, you get an above-the-line deduction for 1/2 of your self-employment tax, and you take that on page 1 of your 1040. And I deliberately did not include the above-the-line deduction when I calculated this originally because I felt that the child support guidelines required us to consider just the standard deduction and just the exemptions and just the child tax credit if applicable. And there are a dozen or so other above-the-line deductions like student loan interest and teacher education supply expenses and stuff like that. And I just said, if the guidelines aren't going to have us pay homage to this, then why should we treat the self-employment income tax deduction any differently? And I gave it some more thought, and I thought, well, it really does. It really is different than all those other things because the employer would be deducting half the FICA anyway. So there is going to be a change coming down the pipe. The other guy's product does it correctly for Social Security, but not for Medicare, which is why it's going to be off by like a buck in every calculation. But at least it'll be closer now. Hopefully close enough that nobody really loses much sleep over it. So that's the self-employment component of it. Incidentally, I want to show you something here. I'm going to set the father's income here at $130,000 per year. And you'll notice, if you're quick on your feet in terms of doing math, you'll notice that the Social Security is capped out at 6.2% of the Social Security wage base, which I can't remember what it is this year. It was $117,000 recently, and they raise it by a few thousand every single year. But Social Security, you get into this problem when you have these high wage earners where their last paychecks of the year, or depending on how high they are, their paychecks starting in March, start to go way up because they've maxed out their Social Security contributions. What this does is this, you'll never see a Social Security deduction, at least in this particular tax year, greater than $1,209 because that's 1/12 of the Social Security wage base for the entire year. So this has the effect of averaging that out over the year. If you have a client that asks you that says, well, the net income on my pay stub is way different than the net income on the calculator, depending on whether they're before or after they hit the cap, that would be why. The next thing, deducting state income tax. And by the way, all these options that I'm showing you are, by default, they're set to what you're going to be under what I call the 90-90 rule, which is what 90% of the people do 90% of the time. So all of these options, self-employed by default is set to no because most people aren't self-employed. Deduct FICA is set to yes by default because most people pay FICA taxes. Deduct state income tax is typically set to yes. But every once in a while you have these goofy situations where you have somebody that has a big pension contribution and they don't pay FICA. I can't remember if the Omaha police are doing that these days, or there's one of the local government agencies is doing that. And so just to show you that it works, if you have someone who's really special and they only pay federal income taxes, you can, let's not make them self-employed. That's not really plausible. So in this case, let's take the father. Let's say he's not self-employed. Let's say he's not paying FICA and he's not paying state income tax, so he's like a police officer in Alaska or something like that. And sure enough, right here, no state tax, no Social Security, no Medicare. And he contributes 4% to his retirement like everybody does. Okay, exemptions. I'm going to change the number of children to 3. This is something that I got really frustrated with the other person's product about. Tax exemptions. I always had lawyers bring 2 child support calculation worksheets to court. If they had 3 kids, they would run one with the mom getting 2 and the dad getting 3, and then they would run another calculation the other way. And I got tired of that, and I said, why can't you just split the exemption in half, because that's what the court's going to do. And you can do that here. You just put 2.5 into each box. You hit calculate, and it literally just takes half the exemption, 2.5 exemptions for each parent. It's not that complicated, and that will give you the effect of averaging that exemption between the 2 tax years. The next thing is the health insurance premium. Now this is something that you need to watch for, and I'm going to show you the pitfall right here. My no questions asked, to disclose a page out of my playbook for those who don't know me, my no questions asked health insurance premium for the kids is $200. If you give me a calculation worksheet that says 200 or less, I'm not even going to ask you for the underlying document because it's just not worth anybody's time. And so I'm going to put this in. I've got the dad at $130,000 per year. I've got $200 in health insurance, and this box here is what I'm going to show you. I haven't touched that. That's the default. If I hit calculate, you're going to see there's a problem with the calculation. And the problem is that my $200 no questions asked insurance premium has now been reduced to $16.67 in line 8. And the reason for that is, since most people are going to enter this, since most people are going to be entering data based on the pay period, in other words, weekly, monthly, twice monthly, or whatever, they're going to be reading it off of a pay stub. I decided to have the insurance by default track the pay period, so you could just copy the numbers down. But in this particular case, you've got somebody that has come in and said, maybe I don't have a pay stub, but I know that the husband makes $130,000 per year. So in that case, you need to select that this is going to be per month for the health insurance. And once we fix that and hit calculate, now you're good to go. You've got the full deduction there, not per pay period. Okay. I see somebody is saying the audio feed is not working. Whoever just sent that message, is the audio any better now? Our first hiccup of the day. Okay, very good. I'm just going to kind of hold this. This looks incredibly awkward, but okay. Okay, so we just covered health insurance. We've covered retirement already. These next few boxes, the previously ordered support and the regular support for other children, these boxes are in here so that you can generate a calculation worksheet that mirrors the Supreme Court's worksheet. The previously ordered support, the guidelines are kind of light on that, but I think it's generally accepted that if there's a support order in place, it doesn't really matter whether they're paying it or not, you deduct it. So that's easy. You just put that in dollar for dollar. If this father has a previous child support obligation of, say, $500 per month, you just put in dollar for dollar what it is. And we'll show you this worksheet here, and there it just deducts it dollar for dollar. And I see we have a comment here from Mr. Donner that apparently the audio wasn't working for the exemption and the health insurance portion. So let's go back and let's just recover that here really briefly. All you need to know on exemptions is that you're going to put the number of exemptions that are allocable to each parent, and you can do a half exemption if there's going to be an alternating year. So in this case, I've put 3 kids. There's 1 exemption for each parent, and then each parent is going to get 1.5 exemptions per year, because 1 year they're going to have 2 and 1 year they're going to have 1. On the health insurance, what I was demonstrating is that by default the health insurance is deducted per pay period, and the reason for that is that if you have somebody that has a weekly pay stub, you're not going to know what the health insurance is per month. You're going to know that it's maybe $50 per week or $25 per week. And so by default the health insurance field will calculate per pay period. In this particular example here, I've set $130,000 per year for an annual pay period, which means that if I have $200 of health insurance per pay period, by the time that averages that out per month, that equals $16.67 per month, which is not what you want. So when you're using a pay period other than monthly, you just need to make sure that you select per month on the health insurance. Retirement does the same thing, and other deductions does the same thing too. You'll notice down at the very bottom here, there's in very large font what you do when you do it in terms of the different, whether you're going to adjust them. But some people still tend to miss that. Another thing I should point out is that, at least as of this current version, the software doesn't like commas. So if I put in 130,000 per year, And this is on the fix-it list, but again, it's not as easy as it sounds. If I put in $130,000 per year with a comma, watch what happens. It puts the dad at $10.83 per month, which is the equivalent of $130 per year, not $130,000 per year. The reason is that when a compiler sees a comma, it assumes that you have separated out multiple variables, and so it assumes that it's 130 for one and then 1,000 for the next one. It treats them like an array. So that's on the fix-it list, but for right now, every once in a while I get calls from people that say that, well, I entered $2,500 for somebody's income and it's coming up as $2. Well, that's why. Okay, retirement we've talked about. Previously ordered support we've talked about is just $1 for dollar. The regular support for other children is also $1 for dollar, but I'm going to show you a different way of handling that when we get into a Prohaska calculation. And then this is something that was probably my greatest frustration with the other product that caused me to design this one, is the other deductions field. It seems like in about a third of our cases, somebody is coming to us whining with something or other that they think should be deducted from their income, even though there's no legal basis of any sort whatsoever. So, we get people that want to deduct 401k loan payments. We get people that want to deduct, maybe they have to buy a clown costume for work or something like that, and they think they should be able to deduct that, excess mileage, whatever it is. Plug the figure in, print your worksheet, and then go make your pitch to the court. But it's intended to give you that kind of flexibility. The other thing that the other deductions field can do is if you have something really goofy going on with your taxes, and if the two arbitrary categories that I give you, taxed at the full boat or not taxed at all, don't work properly, then you can use the other deductions field to square that up. So you can use that to back out excess FICA. Or I had an instance where somebody had substantial pass-through income from a subchapter S corporation that came through on a K-1, where they had to recognize as income, say, $500,000 per year, but in the box for items affecting shareholder basis, they only got distributions of $200,000 per year. Poor guy. I had somebody calculate the excess tax that they had to pay on the $300,000 that they didn't see, and they took that in the other deductions field. And frankly, when you're in a case with the income that high, I thought that was a fair use of the. I thought that was a fair use of the product, something the court probably should have considered. Child tax credit is something that it seems like every year Congress is telling us this is the last year we're going to have it, but it's one of those things that it's the statute that enables it is a patchwork, and every year it's set to expire. And my own cynical view is that they just like to have something to fight over, and so this gives them something that they can have their little token fight, and they can extend it every year. But the child tax credit is typically, in most years, it's $1,000 per kid per year. And so just depending on what your custodial situation is, whether they're alternating exemptions or not, I just give you the ability to choose how many kids it is, and then I do the math for you. So if this person is going to get one exemption every year that they're going to be able to get a child tax credit for, then it just works out to $83 per month, which is $1,000 divided by 12 months. Number of children, I think we all know what that means, and then we'll get into kind of the special kinds of calculations. So the first special kind of calculation is a joint physical calculation. Absolutely. The question for the folks that are on the web, we had a question from Diane in the audience about what legal authority there is to back up a claim that married filing jointly is the wrong kind of calculation. To be perfectly honest, most people run into court and say, I called Adam and he said so. And for most judges, that's actually an acceptable answer, believe it or not. The preferred approach is I called Adam and he said so, and he also said the other lawyer can call him too and he'll say the same thing. And that's diffused a number of these things. But there is, if you go to my release notes, if I go to the main menu and click on release notes, On each of these things, let's see, where is it? Here we go, right here. So the 2013 update that I did, there's the source right there, Revenue Procedure 2013-15. That's where I get my tax stuff from. And if you go to Google and you search for that, you'll be able to download that. It is the most ineloquent PDF document you have ever seen. Okay, it doesn't look like the instructions for your 1040. There's no photographs of missing children in it or anything like that. It is literally a word processing document that just rambles on and on and on. And it covers about, I don't know, 15 or so different things that the IRS is required to inflation adjust every year. My personal favorite, an example of your fine tax dollars at work, is that there's a federal excise tax on manufactured arrow shafts, like you would use to shoot with a compound bow. And Congress, in its infinite wisdom, decided that that tax of about 50 cents per shaft is going to be indexed to inflation. And so that requires an IRS bureaucrat in Washington to do an economic analysis every year about cost index changes in aluminum and things like that, and they literally index this 50% tax to inflation. And so if you go and grab that revenue procedure, you can see how much tax you're paying on an arrow shaft that year. But seriously, for anybody who has any qualms with it, you can go print the revenue procedure. There's only, the tax brackets are on a couple of pages, and you can just show those to the judge and say, look, this is it. The married filing jointly is twice as big as the married filing separately bracket, and this is the data that the calculator uses. So I don't offer as much transparency about what I do for state income tax because there's not an eloquent legal citation that I can give you. Nebraska doesn't do revenue procedures per se, and in fact it was only starting a year and a half ago that they even by statute were required to index those brackets to inflation. But on the Nebraska Department of Revenue website is a page for like tax research or tax history, and they have a very straightforward one-page PDF that you can download where you can see historically what the rates are, and I always use just the most current rates off of that. And I see we have a question from one of the folks on the web. So the question is dealing with railroad retirement, and they don't pay FICA, they do pay railroad retirement tier 1, tier 2, and the medical tier. Do they need to be lumped in together? The answer to the question is that Social Security, from a taxation standpoint, Social Security is the same as railroad retirement tier 1. Tier 2 is in addition to that, and I believe, although I haven't looked at this recently, I believe that the medical portion of railroad retirement is identical to the Medicare tax, which is 1.45%. So in the case of a railroad employee right now, with the current version of the product, you can leave the standard FICA as it is, but you should deduct the RR tier, railroad retirement tier 2, under other deductions, because that's something that by definition I'm not going to be taking into account right now. In a future version of the product, it is probably one of the more requested features. In a future version of the product, under FICA, I'm going to say deduct it, don't deduct it, or deduct it as if it's railroad retirement, and it'll automatically calculate the tier 2 because there is a schedule that you can use for it. I'm just not there yet. Okay, so let's get back to our form here, and let's talk about joint custody. As it stands right now today, on February 12th, joint physical custody is discretionary if both parents have more than 109 days, and it's mandatory if both parents have more than, I believe, 142 days. But you're going to want to check my number on that. So if you have people that have equal time, 182.5, and what this will do is this will then generate the worksheet 3. So your worksheet 1 is the same, worksheet 4 is the same, and then it's going to generate your worksheet 3 for joint physical custody. Now what mine does that the other guy's product doesn't do is mine will actually give you worksheet 3s that walk down the number of children. So with the competing product, you would have to run one for 3 children, one for 2 children, one for 1 child, and I said, why would you want to do that when the software can just do it for you? So it'll give you for 3 children, it'll give you for 2 children, and it'll give you for 1 child. And so you print this calculation and you're good to go. If you have, which seems to be popular these days, a situation where it's 6 days out of 14 to the dad, that's 156, or I'm sorry, that's 209 to the mom, and it's 156 to the dad. And I get that by taking, for the dad, I take 6 days out of every 14, and I multiply it by 26 fortnights in a year. And that has the effect of skewing the calculation a little bit, but it's still a substantial discount from what it would be. The father pays $970 as opposed to paying $1,864 in this particular instance. I had a judge fairly recently tell me that actually the number of days for the dad should be 157 and it should be 208 for the mom, and I told the judge 157 is a prime number, so I don't know what you multiplied to get to that, but it wasn't anything other than 157 and 1. And then just to demonstrate here, some of the errors that can spit out, I think I do an error for this. If I try to use Worksheet 3 and I only give the dad 65 days of parenting time, then it's going to give you an error it's possible to override this error, because there may well be a reason why, even for settlement purposes, why you would want to use a worksheet that's skewed like this. So if it's less than 109 days, it'll say please double check, and you can either go back and fix it, in which case it'll bring you back to the worksheet, or if you want to override it, if you have a reason for doing it, you just click the link on the bottom and it'll run the calculation, but it'll disclose on the worksheet that you've got an error that's been overridden. Also, other things that can generate those waivable errors are if you have exemptions that don't match the number of parents. So here, let's give the mom 4 exemptions. Now it's going to start to get upset with you. So it's going to say the number of exemptions exceeds the parents, and you have the wrong number for joint physical, and so you can ignore the errors and run the calculation, and it'll keep piling them on. And then one that you can't override is to do joint and split at the same time, because our guidelines don't know how to do this. I have a method that I tell people, but there's no legal support for it, so I'm not going to write a calculator that looks authoritative when in fact it's not. It's just guessing. So if this is the case, the joint and split can't be overridden, and so it just won't let you do it. So you have to go back and undo that. Okay, so let's take out joint, and let's do split only. Split custody is when you have 1 or 2 kids living with one parent, 1 or 2 kids living with the other parent, and that's just, it's literally a plug and go, except I have my exemptions wrong. So in this particular case, I've got my worksheet 1, I've got my worksheet 4, and then for split custody, the worksheet doesn't look quite as pretty. It's not my fault. The Supreme Court requires that we do it this way. And in this case, I left it until the very end to plug in the kids' names, because I wanted to allow the user to kind of play with things and get it the way they wanted before they had to plug in all this extra information. But if we just plug in some kids' names, I don't know what people are naming their kids these days. If you plug those in like that and then you hit print, those printed names will actually come out on the printed worksheet if you have somebody who cares about that. So let's go back and cover Prohaska calculations, and then we'll cover deviations. Prohaska calculations are, well, they used to be really difficult to do because you'd have multiple calculations that you had to do, and it was never as straightforward as you thought, because whenever you have a Prohaska calculation, inevitably you have a really big dispute over at least one of the 3 parties' incomes. So then you're doing multiple instances of it, and this straightened that out a little bit. So in this case, let's assume that the dad has subsequent children, and so we're just going to check the box that says the dad has subsequent children, and we're going to hit calculate. Now it's going to give you the same form here, except all it's asking you for is what's the income information for the father's spouse. And so let's assume that the father's spouse is really a homemaker, and we're going to just put an earning capacity on there of $10 per hour. In this particular instance, it's probably appropriate to do married filing separately for the father and the spouse, because they're probably filing a joint tax return, but your mileage may vary on that. And in this case, I'm just going to give the father's spouse 1 exemption just for themselves. And so let's assume that they have 2 subsequent children as this calculation, and let's assume they don't contribute to retirement. I'm going to hit calculate here, and now this is going to give me a 3-step calculation which is endorsed by at least the Nebraska Court of Appeals in the Prohaska opinion, Prohaska v. Prohaska. And I want to emphasize that the Prohaska opinion states that this is not the exclusive way to do calculations for subsequently born children. So don't go running around saying, well, Adam Astley said this is the only way to do it. It's not. However, this is the only way that is a safe harbor where an appellate court has said the district court did this and we're not going to reverse them. So I found that this is probably more popular than any other method of doing this. The child support enforcement lawyers that are using a different package that's published by Health and Human Services, they actually do a 4-step calculation. Some of the lawyers from an older generation will do a 2-step calculation, and then in the Prohaska opinion, they endorse the 3-step calculation. When I wrote this product, I was curious about whether any of that stuff made any difference at all. And so what I did, well, to show you, for those of you who haven't seen a Prohaska 3-step, the first step is it's a calculation between the parents that are the parties to this action. And so it establishes kind of a preliminary seed number. In this case, since it's the father that's got the subsequent children, the preliminary seed number is 1864. That's how much he's going to owe as a result of this divorce case or custody case, with no modifications for a duty to support afterborn children. The second step is then a hypothetical calculation between the this person and the subsequent spouse. And you'll notice I screwed this up because I put in annual income of $10 for the subsequent spouse, so they have gross income of 83 cents per month. But it works. So we'll just roll with it. In this instance, we have deducted the $1,864 unrounded as regular support for other children in Step 2 because the Prohaska opinion requires the court to give consideration of the balancing that has to happen between the 2 families. And so this gets us to a result here of $1,670 per month, and that's the amount of the deduction that you're going to get when you get back to the actual case. So Step 3 then is a calculation between the parties, and it's going to deduct $1,670 unrounded as the regular support for other children based on the result of Step 2. And then from that point forward, it's going to walk it down 3 children, 2 children, and 1 child. So that's how a Prohaska calculation works, and that it's intended to make your life a lot easier. Yes. The question for the benefit of the folks that are on the webinar is, do you take the exemptions into account for the subsequent children? The answer is yes, you should, because those affect the tax deductions that are going to be taken. And in fact, you should take those exemptions into account when you are putting in the party's income on the regular form as part of Step 1. So if there's 2 subsequent children and they're going to be sharing the exemptions with their spouse, you should raise the party's exemptions by 1. And then you should probably give 1 to the party's spouse, although that's not going to affect it greatly. Now we have a couple of questions here. I see we have one from Karen Hicks. What if there's subsequent children but no subsequent marriage? And then from Jennifer Rowling, is it typical that both parents receive the credit for subsequent children? So first question, subsequent children but no subsequent marriage. The guidelines don't impose a requirement that there be a marriage, but the court is going to want to know, are you either under a legal duty to support these subsequent children or a moral duty? I've seen cases where after the initial action there's a guardianship of other children and there's children living in the house and they're providing regular support for them, and I think that's fair to take that into account. I've also seen situations where there's a long-term relationship, but they're not married and they have a child together and they're living together like a family, and it's clear that they're financially acting like a family, and I think that's fair to include that. But there's no legal requirement of remarriage. And then the other question about is it typical for both parents to be able to take credit for subsequent children? The answer is yes, but that's kind of a round peg in a square hole as far as the guidelines are concerned. The guidelines state that a duty to support subsequent children is an affirmative defense to a request for an increase in child support, but it's not a reason to lower child support by itself. And that's, I'll get to you in 1 second there, Karen, I saw you. And that language is hugely problematic because that leaves open the door of somebody who has had no other change in circumstances except now they have subsequent children, and then they have a little change in circumstances which may not be enough to get them a 10% deviation in the child support amount, and they go to court and they say, I understand that the subsequent children is not by themselves reasons for a reduction in child support, but I have the subsequent children and this other little thing. And so, Judge, I want you to add them both together and give me a reduction of 25% of my child support. And believe it or not, I've seen judges actually buy that. And it doesn't make any sense. I think it's poorly worded, but it doesn't make any sense that it's certainly not in line with the spirit of the guidelines. Now, you also have an open question of whether prior-born children count, and that seems to be pretty clear that they do. And when you have prior-born children, I mean, sometimes I've got one going right now where the child that is the subject of a paternity case is the product of an extramarital affair, and the couple didn't divorce. They reconciled and they got back together after the affair, and they have children together. And I'm running a Prohaska calculation with my client and the client's spouse versus the mother of the child that was the product of the affair. And I think that's perfectly fair because those are prior-born children. They aren't subsequently born children. Go ahead, Karen. Okay. Very good. Okay. Let's talk about high income and low income. To talk about high income, actually the income has to go pretty high. I'm going to set the dad's income at $300,000 per year, and I'm going to take out the subsequent children portion. When the net income exceeds $15,000 per month, the guidelines give us a safe harbor that allows the court to order additional support above and beyond what it would be at $15,000, but they don't have to. And that safe harbor is found in Section 4-203C of the guidelines. And basically what it does is it says for every dollar over $15,000, depending on how many children there are, we are going to take a marginal rate and we are going to add that to the total support obligation. There's no official form for doing this, so I just wrote my own. And if you have income that is higher than $15,000 net income between the parents, this optional worksheet here that's at the bottom will automatically generate itself. You don't have to do anything. I want to emphasize, though, that this is optional. The court can award the support that's on Worksheet 1 and Worksheet 4, and it's not an abuse of discretion. And so what I have said, at least in terms of how I view these high-income cases, is I view Worksheet 1 and then the optional worksheet as kind of drawing the edges of the goalposts, if you will, and the court has to get somewhere between them. And so in this instance, the support's going to be somewhere between $26.41 if we don't go with any extrapolation at all, and $31.26 if we do go with some extrapolation. And if you think about that, I mean, this is a person that makes $300,000 per year, and the decision about whether to extrapolate or not is a decision that has an effect of $500. So in the grand scheme of things, it's not going to make or break anyone's bank. But I have said that I really view this as being, you know where the boundaries are, and now it's up to the lawyers to actually introduce some evidence to the court to explain why the number should be higher or lower. Do these children have special needs or activities that are costly, or what are the overall economics of the picture? I think in this case, a monthly expense report, almost like you would do to prove up on an alimony case, could be valuable in terms of convincing the court, if you represent the recipient, that it should be a higher amount. But the guidelines say that if you use this formula that's found in 203C, that it is not a rebuttable presumption, but that the court may do it, which is why I call it a safe harbor. And I always tell judges that if you hit it somewhere between those two ends, you're going to be safe from getting reversed. So we talked about high income. Let's talk about low income now. There's two different low-income thresholds in the guidelines. There's the poverty level limitation, and then there's minimum support. So I'm going to deal with, this should be enough. We're in the minimum support here. Let's, this guy has negative income because they're paying too much for health insurance. Let's take the health insurance out. Okay, we're still into minimum support, but I'll explain this and then we'll add a little bit back in. Minimum support's real simple, which that's why he's in minimum support. He's paying $500 for a subsequent child or for a prior child, but only makes $1,000 per month. That's more like it. Okay. So in this particular instance, we're dealing with somebody that after they pay all of their expenses, they're still just slightly below the poverty level. This still isn't right because this person isn't paying. We've really screwed this up. We are going to deduct FICA. We are going to deduct state tax. No, this person is not going to contribute to retirement, making $1,000 per month. That's what it's supposed to look like. Okay. So we're dealing with somebody who makes $1,000 per month, and their income is still low enough. They're not going to pay any federal tax. They're not going to pay any state tax because the exemptions are eating all of that up. And they are going to pay Social Security tax. They are going to pay Medicare tax. We disregard the fact that they may get that back if they're a custodial parent under earned income credit because that's means tested. And so in this particular instance, the net monthly income is $923 per month. $923 per month. But the poverty level is $950-some per month, so we're below the poverty level. So minimum support is either $50 or 10% of their net income. So here we have minimum support is $92. Let's raise their income up a little bit. I think I have to go to $1,150 in order to get it where I want it. A little more. Okay, here we are. So now I have their income as low, but it's not below the poverty level. So in this case, the net income of the party is $1,200 and some change per month. The normal child support obligation would be $414, and so if they paid the normal child support obligation, that would put them below the poverty line. And so in this particular instance, the poverty threshold applies, and we're simply going to adjust it so that after they pay their child support, they are right at the poverty line. So it's interesting because as you get closer and closer to the poverty line, you could be to the point where your poverty level support is actually less than your minimum support, in which case the minimum support will kick in and that will push you all the way over the poverty line. And this is something that, you know, if you take a pro bono case or if you're representing folks that are lower income, this can be a big deal for some of these folks. I had to become highly familiar with it because programming this was an interesting task, but I think it helps sometimes for us to understand just how these work and how many different rules come into play when you're dealing with a low-income case. So since we're talking about low income, let's talk about cash medical support. Cash medical support is something that the federal government imposed on the state, and then the Supreme Court imposed its own unique interpretation on all of us. And cash medical support is it's the lesser of 3% of the payor's gross income, or the lesser of the extent to which their income after payment of child support is above the poverty line. So if you're dealing with an adjusted support case, either under the poverty line limitation or under minimum support, then cash medical support is always going to be zero. Because once they pay their child support, we know they're at or below the poverty line, and so cash medical support is going to be zero. But what the Supreme Court did is they took the recommendations of the Child Support Commission, which was basically to do what the feds were ordering us to do, and they tweaked them a little bit, and they said that cash medical support would be treated like health insurance, and it would be prorated between the parents. And for a computer programmer, this created what we would call an infinite loop, or for a non-computer programmer, what we would call a chicken and the egg problem, which is where in order to know what child support is in cases that are close to the poverty line, you have to know what cash medical support is because it's a deduction and it's prorated. But in order to know what cash medical support is, you have to know what child support is because cash medical support could be limited by the combination of net income, child support, and the poverty line. And it seemed to be inescapable, but I sat down with Bill McKenzie over lunch and we worked it out. And so what I'm going to do, I can't remember exactly where this has to be in order to be a close case, but I'm just going to take a stab at it in the dark and see if I can make this work. No, I need to raise it up just a little bit more. Let's try 1,500. Need to add another 150 or so. There we are. So in this particular instance, I've got net income of $1,481. I've got child support of $482. So this person is just barely sitting above the poverty line after they've paid the child support. And so I look at the cash medical support calculation. 3% of this is $49.50. I take their net monthly income. I deduct the child support out of it. I apply the poverty line threshold. That's why I was off by $15. It's $9.73 now. And then I've got $7.05 left of income that is available to pay cash medical support. But the problem with the Supreme Court formula was that what I'm doing is I'm prorating it, and so I'm cutting it down, and then I'm prorating it again, which in the end means there's going to be less money in the state's coffers because cash medical support is really to reimburse Medicaid funds. And so what I did was I added back the prorating, and this is what happened with Bill's blessing. And I end up taking that cash medical support up to $26. And so the end result is that we get to the spirit of the Supreme Court's rule, but we have to jack with the worksheet a little bit. We end up having this particular obligor, in this case, where it's close to the poverty line but not below, where they're paying the full amount of cash medical support that they should pay, and it's going to, between their net income, the child support, and the cash medical support, it's going to keep them at least $1 above the poverty line, which is what the whole goal of the policy is. So that's cash medical support. You now have more of an understanding about it than you need. The short answer is if you're in a cash medical support case because someone's on public assistance, just check the box, and the software will do the rest for you. So that's, we're at 3 o'clock, and we've covered kind of all of the major features. Does anybody either in the live audience or on the webinar have any questions or anything they want me to cover that we haven't covered? Yes. The question is, for the benefit of the folks on the web, if you're what I call a legacy user, which is somebody who paid for a subscription before it became available as a free member benefit, what do you do with your saved calculations? And the answer is yes, they do. What you have to do is go to the main menu. You have to establish your new account through the NSBA. And incidentally, if you've never signed on to this before, you literally just go to the page and just log in using your NSBA credentials, and that account will be created for you automatically. You don't even have to give me your name. I get that from the Bar Association. What you do is, if you're signed in under the Bar login, you'll see this option here on the left-hand side that says Import Your Saved Calculations. You won't see this from the Legacy side. And then it will ask you for your credentials for your Legacy account. Even if your Legacy account is expired, even if your Legacy account was a free trial that you created back in 2011 and never paid me for, if you saved the calculation under it, there are some people out there, believe it or not, Jim, that have created 6 and 7 and 8 free trial accounts. They've worked really, really hard to avoid giving me $99. Even if it's a free trial that you never paid for, if you saved the calculation under it, and if you can remember your username and password with all the different variations that you had to use for that, you plug it in here, it'll list your saved calculations, and you can select to import all of them, import some of them, and so on. I see we've got a couple of other questions here on the webinar. Someone wants to know, can you add a search box to the saved calculations? Answer, no. Here's why. I'm going to go to Save Calculations here. I've only saved a few of these because I'm relatively new in my complimentary subscription. On the Apple, I'm going to hit Apple F, and I'm just going to type what I'm looking for, and it's going to come up for me. And I can search through here. On the PC, it's Control F. So no, I'm not going to add a feature that's already built into the operating system. Next question is, do parents take an exemption for themselves and divide the children? And the answer to that question is yes. So if you have, say, 2 parents and only 1 child, if you're going to alternate that exemption, it would be 1.5 exemptions per party. And I try to explain that, although there's not a whole lot of screen real estate on on here, but I try to, in the exemptions box, I have blank including the mother and blank including the father. So the exemption for the party themselves should be included in the count that you include there. The next question is to please explain the filing status again. And we have, we've got a zinger. What's the best way to address depreciation add back in excess of the straight line? Okay. Well, let's cover exemptions first. The exemptions should be the the filing status should be the filing status that you're actually going to take as part of your calculation. Typically, that's going to be either single or head of household. You shouldn't use married filing jointly, and the reason why you shouldn't use that is because in most instances that's going to underestimate the tax. But you should use the filing status that is legally appropriate for the party. Add back of excess depreciation. If you're dealing with an established business that buys assets every year, then the depreciation add back is going to be the most frustrating process that you've ever encountered, because if you're always adding assets every year, then you're always going to be heavy on the front end of new assets and light on the back end of old assets. And so if your revenue is relatively flat, then when you do that, the depreciation is all going to end up being a wash. And so a lot of times I start with the notion that we don't even bother with this, and if the opposing lawyer wants to make an issue out of it, then I'll do the worksheet, and then I'll really tell them why we shouldn't bother with it. But in terms of making adjustments for that, I would do the depreciation add back as tax-free income, because that's really what it's going to do, is it's going to affect the bottom line. The other thing that you could do is, if you wanted to tax affect it, you could simply deduct it from the taxable income. Let's see, we have a couple of other questions here. Oh no, somebody wants to know my thoughts on something. This may be a mistake. Your thoughts on why the law has never exempted alimony payments, since that may impact the ability for a parent to provide for their own living expenses. That's a very interesting question, and not all states treat this the same. I had occasion to look at Minnesota in a recent case, and Minnesota actually considers the wealth transfer of alimony before calculating child support. So you would deduct the alimony from the payor's income, and you would include it in the income of the payee. Our guidelines have just taken the opposite approach, and I think it was just a policy decision. I think their attitude was that we're going to calculate child support first, and then the guidelines explicitly say that the court's supposed to consider alimony based on income that's left after child support is paid. And I get that. You've got to do one way or the other, but I do agree with Jason here that asked the question, which is that when you deal with these judges that look at alimony formulaically, like if they use a rule of 72 or a rule of 10 or a rule of whatever, where they're doing it as some multiplier based on the payor's income, then it can get oppressive, and particularly with temporary orders where it's not only child support but it's alimony, and you're going to pay half the visa bill, and you're going to subsidize the mortgage and stuff like that, it can get oppressive. Our Child Support Advisory Commission just met and just turned in their report within the last month or so to the Supreme Court, and that's not a subject they broached at all. So unfortunately, we're stuck with that for at least 4 more years. But that's, Jason, I hope I answered your question. That's all the thoughts I really have on that. Does anybody else have any other questions, either on the web or live? The question for the benefit of the folks on the web is, should the child tax credit be the same as the exemptions? And in most cases, yes, but what I'm not real fresh on, because I haven't had to look at this for a while, is in terms of claiming the child tax credit, I seem to recall that you have to be both eligible to claim the child as an exemption because they live with you, and you have to actually claim the exemption. So let's assume you had an agreement where the dad was going to take all the exemptions, but the kids lived with mom. If I'm recalling correctly, and again, nobody rely on this because I'm not real fresh on this, but if I'm recalling correctly, nobody takes the child tax credit in that instance. And so I wrote the program the way I did just because this seemed to be so fluid. This is like a ping pong ball that they want to change every single year. I didn't know what all the different possibilities were going to be. So I decided to make that the user's problem instead of my problem. Any other questions? Okay, well, thank you all for participating. For the live people, we have a sign-in sheet in the front that I think you did, and for the people that were on the webinar, I believe that Elisa gets an automatic indication of when you signed on and when you signed off, and so I think the attendance is handled that way. So thank you all, and we'll see you at the next event.